I'm Alan Kinney, Editorial Director with REIT.com, and I'm in Chicago for REITWeek 2013, NAREIT's Investor Forum. Joining me is Sunstone Hotel Investors CEO Ken Cruse. So Ken, give us an update. What's the state of play in the lodging space right now?
Yeah, thanks Alan, and thanks for having me here today. Business travelers are hitting the road in record numbers. Leisure travelers are coming back very strongly, and group business, which has been kind of a laggard during the course of this recovery, which began about 42 months ago, is also starting to come back fairly strong. So as a result, industry occupancies are at around prior peak levels, close to 80%. Industry rates are also approaching prior peak levels, although they're slightly behind that. Things are generally good. I think we're tied up with the broader economy. So as with any cyclical recovery, you've seen fits and starts and little bumps along the way. But in general, it's been a very healthy recovery. I think we're entering into what we would characterize as the sweet spot of this recovery, in that now that we're at peak occupancy levels, we can start to drive more and more of our demand through rate, which translates into much better profitability of our hotels. So as we've seen in prior cycles, during the last 4, 5, 6 years of a cyclical recovery, you tend to see good growth in rate in the hotels, nice profitability improvement, which typically translates into good share price improvement as well.
Okay, so if you're in the sweet spot, what are you doing then to attract travelers?
Sure, great question. Since we're in Chicago, we have the Hyatt in downtown Magnificent Mile in Chicago. We acquired this hotel a year ago. When we bought it, it had the wrong brand, it had the wrong operator, and it was clearly poorly capitalized for the potential demand that the hotel could generate. As a result, we came up with a whole new business plan for the asset, brought in a new manager, brought in Hyatt as the flag, received some incentives from Hyatt to do that, came up with a full comprehensive repositioning program for the hotel. We're just now wrapping up with a $25 million renovation of the hotel. Starting from the top floor down to the bottom floor, everything is new. It's a new style that appeals to a very high-rated business transient traveler in the market. We've created a much better fitness facility. We know that high-rated business travelers like a great fitness experience in the hotel. We've created a lobby, bar, restaurant experience that's generally seamless. It's not the old style, truncated, here's your lobby, here's your 3-meal restaurant, here's a specialty restaurant, bars over here. Very inefficient F&B operation. We've got a full integrated system in this hotel where F&B, library area, check-in area, public spaces are all integrated. Creates a system where customers enjoy spending time, whether it's socializing, working, interacting, eating, drinking, what have you. They stay on property longer, they spend more money in our hotel, everybody's happy.
So then how close do you think we are, I guess, for the hotel sector as a whole in terms of, reaching a full recovery?
Sure, and a full recovery is kind of a nebulous concept in our business. We're back at prior peak levels of occupancy. That doesn't mean it's a structural peak in terms of what our hotels are capable of achieving. We have hotels in Times Square, for example, that run at 98% occupancy throughout the year. So an 80% occupancy level is a starting point in our opinion. We can do better on occupancy. So as far as the recovery has gone, it's 42 months long so far. There's no typical recovery, but we've seen recoveries in the past from trough to peak last anywhere from 70 months to 90 months or more. We think that this recovery probably has all the earmarks of being a longer lasting recovery, mostly because it's been a fairly slow growth recovery, slow and steady. One of the biggest factors in determining the peak of a cycle and the magnitude of a cyclical trough is supply. That's new hotels being built. Right now, supply is very limited in our industry. It's running at about 0.8% of existing room base last year, moving up to maybe 1.4% of existing room space this year. That's well below the demand trend, so a very healthy dynamic between demand and supply. That's very positive. Implies, once again, that this cycle will continue going forward. Supply probably is the one thing we want to watch, though, in terms of when the cycle may end or when we may reach the peak of this cycle, because once again, that does tend to truncate things. The other piece of the puzzle is because we're highly economically sensitive, we're very tied to the broader economy. If something were to happen with our economy where we entered into another recession, that obviously would also be a harbinger for the end of the lodging cycle.
Well, Ken, thank you so much for your time.
Thanks, Alan.
And for more on this and other REIT news and analysis from REITweek 2013, be sure to check out REIT.com.